Okay, in this video, we're going to take a look at leverage ratios. So a third set of ratios. And with these, we're going to be taking a look at the use of debt by the firm. So we're going to see how much debt they're using, how well they're using, how able they are to handle the obligations of the debts. So first, let's take a look at a definition of total debt. We're going to look at the total of all interest-bearing obligations. So all liabilities that have some interest associated with them. So clearly any bank loans or bonds would be included. Notes payable would be included. But specifically, there are some current liabilities that would not be lumped in as part of total debt. So things like accounts payable and any accruals would not be included. So anything that's doesn't have a specific interest obligation attached to it, we would not include. And so with that definition of total debt, we can go down to the total debt ratio, and that's going to be simply the total debt of the firm. Again, the interest-bearing obligations of the firm divided by the total assets. Debt to equity is the total debt divided by total equity. So a slightly different denominator, but both of those ratios, the total debt ratio and the debt to equity ratio, are both going to be measures of how much debt the firm is using. The higher those numbers are, the more debt the firm is using. They're giving, again, the same pictures, but from a different viewpoint. So debt to equity will be higher, but if debt is increasing over time, both of those ratios will be increasing over time and tell you that story. The market debt ratio is, again, a similar kind of picture to the first two. It's going to be defined as the total debt divided by the debt and equity, but now it's not the book value of equity, which is what we're using in the debt to equity ratio. That's the equity number we're using there, the book value of equity. Now we're going to be using the market value of equity, and we'll, as we look at the specific calculations, we'll talk about how to come up with that number. The equity multiplier is, again, another measure of how much debt the firm is using. The higher the number here, again, the more debt that the firm is using. But this one is defined slightly differently. It's equal to the total assets divided by the total equity. And these next two are measures of the ability of the firm to meet the interest obligations. So anytime you have debt, you've signed up for a regularly occurring interest payment, and sometimes even a principal payment along with it, to the bank, to the lender, and you got to pay that on time, all the time. And so these next two measures are looking at the ability to pay those obligations from your operating earnings. Times interest earned is probably the only one that we'll use in the class, but the EBITDA coverage is another one that may be used. It's particularly important if you've got leases involved, kind of off-balance sheet financing, a little bit beyond the scope of our class. I kind of want to keep it a little bit simpler, and so we'll focus mainly on the times interest earned. So, and that's defined as EBIT. So basically your operating earnings, operating income, divided by the interest payments that you have to make. So let's look at our Home Depot and calculate each of these ratios. So the total debt, again, is going to be equal to all the interest-bearing obligations. And so I'm going to, just in this cell right above, calculate what that number is. So let's go to the balance sheet. That's where all of our obligations are going to be, all of our debt obligations. And they're going to be in the liabilities section. So I'm going to go past the total assets down here to the liabilities. Accounts payable is a liability, but it is not an interest-bearing one. Neither is accrued expenses, but the notes payable, short-term debt, I am going to assume is a debt. The current portion of long-term debt would be another thing that we're going to include. Other liabilities, I'm going to ignore those and just play like those aren't interest-bearing. To find out for sure, I would look at the notes on Home Depot's financial statements. For our purposes, it's okay if we just ignore them for now. We do also want to add in the long-term debt. So this one right here, that's clearly going to be interest-bearing. And we get a number of 4085 for our debt. If you go back to, I just saw something on the Home Depot balance sheet. They have a number that's called total debt, but it excludes the notes payable. So they're basically looking at the long-term debt. They've got the long-term debt plus the current portion of long-term debt. So 2,672 plus 513 is coming up with the number that they have, the 3,185. We want to include all interest-bearing things. Notes payable is interest-bearing, so our number is slightly higher. Our total debt number is slightly higher than what they're showing here on the balance sheet. So we've got total debt of 4085. I'm going to change that format, and I'm going to copy that across. So that's the total debt number, and we can use that for several of these calculations. So to figure out the total debt ratio, I'm going to take the total debt and divide that by total assets. So again, I'm going to go back to the balance sheet for Home Depot, find total assets here. So we don't want current assets, that would be this cell up here. We want all assets. So we'll divide it by row 15. And I'm going to copy that across. And so this is saying in 2006, about 9% of assets are financed with with interest-bearing debt. Most of that is long-term, but there is some short-term notes payable. So 9% of their assets are financed with debt, and that climbs over time to 36%. So from looking at this particular measure, debt has grown by about fourfold over this 8-year period. So they're clearly using more leverage. They've made a decision, hopefully a strategic one, to take advantage of maybe cheap debt financing in the marketplace, maybe return some capital to the equity investors, to stockholders. But regardless, they are using more debt, and it's been going up over time. And if we kind of look across here, starting from 2009, it's gone up every year. And in the most recent year, from 2012 to 2013, it was actually a pretty significant jump, from 26% of assets to 36% of assets being financed by interest-bearing debt. So debt has gone up, and that's what that measure, or that ratio, is telling us. Debt to equity, we're going to use that debt number and divide it by equity, the total shareholder equity. Again, that's on the balance sheet. And I have a number here called total equity, and my number is 0.15 for this year. And so it's now not 15% of equity is financed by debt, because these are two different ways of financing assets. It's saying that debt is 15% of equity. It's smaller than equity. And if we look at this across time, we're going to see a very similar kind of story to the total debt ratio, that debt has gone up over time. And in 2013, now we have more debt than equity in terms of financing our assets. Debt has become a much bigger portion over time, and now it is a bigger portion than even equity in terms of financing the assets of the firm. But both of those, please notice that both of those tell qualitatively the same story, and that is there is more debt being used by the firm. The use of leverage, the use of debt has gone up. So for the market debt ratio, we're going to be taking a look at the debt divided by the debt plus the market value of equity. So it's going to be slightly different than the debt to equity ratio that we just calculated, where the equity number there was the book value of equity, so the equity number from the balance sheet. Now we're going to go away from the balance sheet and look at what the value of equity is in the marketplace. So basically, if you're familiar at all with the stock market, the market cap of the firm. And we're going to use that for each of the past several years. I'm going to go back to 2008. And we're going to take a look at the total number of shares times the price per share at the year end, and that will give us the market value of equity at that particular point. So I wasn't able to get that information for 2006, 2007, but I've got it for 2008. And so what I'm going to do is have the debt number, so we've got that right here, divided by the debt plus the market value of equity. And so if I go again back to the balance sheet, down here at the bottom, I've got the number of shares outstanding and the year-end stock price. And if I take the product of those two numbers, I will have the market value of equity. And so for 2008, we're going to take that number multiplied by this number, and that will give us the market value of equity. Let me just put some parentheses here to fix up the formula. And so I got a number of 0.269. And again, if I copy that across, we have a slightly different picture now. The leverage number is going down, but it's mainly because our market value of equity has gone up substantially over time. So from 2008 to 2013, the value of our equity has really grown, although the book value of equity hasn't grown all that much. So let's just go back to that sheet I calculated this stuff from. The stock price has gone from 18 to 75, and currently it's over $100 a share. So the market value of equity has grown substantially. And if we're looking at debt in terms of market values, then we don't see quite the same picture of an exploding use of debt. In fact, it's gone down as a proportion of market values. So a slightly different take now, and maybe a little bit different picture, a little different story about the use of debt. Maybe we were a little bit concerned in looking at the first two ratios and seeing how much debt increased over time. But in looking at it in terms of the market value of our equity, now that number has actually gone down, and we might be less concerned in looking at the use of debt by the firm. Of course, that's going to be sensitive to market conditions. If there's a slump, a stock market slump, and stock prices go down, that number is going to move quite a bit, whereas the book value of equity is a little bit more stable. Regardless, let's keep moving and get a holistic picture of what's going on with the debt of the firm. With the equity multiplier, we're going to take a look at the total assets divided by equity. Those are both balance sheet numbers, so I'm going to go to the balance sheet for Home Depot, and I'm going to get the total assets number, which is here. Divide that by the total equity number, which is here. And so we have 1.65 in 2006, and that's going to increase substantially. We're up to 3.2 in 2013. So again, by this measure, we've kind of doubled the use of debt. We've got, for every dollar of equity, we now control twice as many dollars of assets. And that's by virtue of the use of debt in the firm's capital structure. So for times interest earned, I'm going to take the EBIT divided by the interest. I've already looked at the income statement for Home Depot, and I noticed that there's nothing there that gives me very clearly what the interest expense was. So I'm going to have to go to the cash flow statement, and down here I see a line item that shows me what the cash interest paid number was. But I only have that for 2008 through 2013, so I'm going to have to do these calculations, the interest coverage calculation, only from 2008 forward. So we'll go back to our comparison sheet, and in 2008 I'm going to take the EBIT divided by interest. EBIT is the same thing as operating income, and so I will use this number, 2008, and divide that by the cash interest paid in 2008, and I have a number 7. So there's 7 times more money made in operations than the firm had to pay in interest. So they were very comfortable in terms of being able to pay their interest obligations. Now, as I look at that number going forward over time, even though the firm is using more debt, it's more than doubled in terms of the times interest earned. And it's basically because their operating income has grown substantially. And actually, there's probably another thing going on there. Interest rates have gone down over time. So even though you may have more debt outstanding, the interest charges could actually go down if the interest rate changes enough. This is giving a slightly different picture of the firm and their use of debt. Even though they're using more debt, they're actually more able to meet the interest obligations that they've incurred. And so, whereas this number going from 9% to 36% might start to cause a little bit of concern, the fact that their ability to service the debt has gone up substantially gives us a lot more comfort in terms of examining their use of debt. So again, going back to the idea that we need to look at things kind of holistically, put things together, and start to paint a picture of what's going on with the firm. So although the use of debt has gone up quite a bit, it's not a cause of concern for the firm. We're going to stop there. We've taken a look at the leverage ratios, done some calculations. We'll swing back in the next video and take a look at profitability ratios